Okay, let's dive right into this. Welcome to The Explainer, where we're going on a seriously deep financial dive today. We are taking an absolute giant of the retail world, AutoZone, and putting it through what we like to call the valuation gauntlet. We aren't just going to sit here and look at a stock chart. No, we're going to analyze this $49 billion auto parts empire through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, before finally running it through our own modern quantitative models. Let's find out if this company is a true compounder or just a value trap.
So here is our roadmap for today. We'll start with the AutoZone snapshot, then move to the Buffett lens, the Lynch lens, the Graham lens, quant valuations, and wrap it all up with our synthesis and verdict.
Section 1. The AutoZone snapshot.
$3,013.03. I mean, just look at that staggering number for a second. That is the current share price of AutoZone, which gives it a massive market capitalization of just over $49 billion. It's a colossal footprint, right? And a price tag that instantly tells you this company has been compounding value for a very, very long time.
But you gotta ask, what exactly justifies that $49 billion valuation? Well, AutoZone is the leading auto parts retailer, operating an incredible 7,856 stores across the Americas. And according to Fitch Ratings, what really sets them apart is their heavy service component and the absolute need for purchase immediacy. Think about it. When your car battery dies, you're not gonna wait 2 days for an online delivery, right? You go straight to AutoZone to get your car running today. This real-world urgency makes their whole business model highly resilient to those giant e-commerce competitors.
Moving right along to Section 2, the Warren Buffett lens.
So, you know Buffett. He looks for economic modes, consistent earnings, and really high returns on capital. So how does AutoZone stack up against this notoriously rigorous checklist? Honestly, it is a Buffett dream. Their economic moat is super wide. They're the industry leader in a really fragmented market. Their return on invested capital is a blistering 26.65%. Now, you might look at their debt and kind of wince, but they operate at a 2.5x EBITDA leverage. Let me translate that financial jargon for you. It simply means their debt is incredibly well structured and it's easily covered by their massive operational cash flow. You couple all of that with 10 straight years of steady earnings growth, yeah, Buffett is definitely paying attention.
$1.63 billion. That is AutoZone's trailing free cash flow. In Buffett's world, we actually call this owner earnings. Literally the cash that could be pulled out of the business by the owners every single year without harming operations at all. At a $49 billion market cap, that represents a free cash flow yield of around 3.3%. It's just a massive, predictable cash machine. Buffett would absolutely love this business, provided, of course, he could get it with a sufficient margin of safety.
Section 3. The Peter Lynch lens.
Now, Lynch loved categorizing companies so he could really understand their growth potential. And under his specific system, AutoZone is the textbook definition of a stalwart. Fitch notes they have a long-term average comparable store sales growth of around 3%. So it's not some fast-growing tech stock. It is a massive, established entity that offers really steady, highly predictable, but non-explosive growth. These stalwarts, they provide vital protection during recessions.
But here is exactly where Lynch would have a fierce internal debate with himself. On the pro side, AutoZone boasts a PEG ratio of 1.37. Lynch loved a PEG near 1.0, and with analysts forecasting EPS growth of almost 17% next year, 1.37 is quite attractive for a company of this quality. But on the con side, 93.40% institutional ownership. Lynch absolutely loved finding hidden gems that Wall Street was completely ignoring. With 93% ownership, literally every suit on Wall Street already knows about AutoZone. Because it's such a crowded trade, Lynch would likely rate this a strict hold.
All right, Section 4. The Benjamin Graham lens.
The father of value investing focuses heavily on asset-backed safety, and Graham's defensive investor checklist is notoriously tough. AutoZone passes on adequate size, it passes on earnings stability, and it actually has a moderate price-to-earnings ratio of 20.69. But it completely fails Graham's financial condition test. Graham wanted a current ratio, which is just current assets divided by current liabilities, of at least 2.0. AutoZone sits way down at 0.89. Furthermore, Graham demanded a long, uninterrupted record of dividend payments. AutoZone pays absolutely zero dividends, choosing instead to funnel all that cash straight into share buybacks. But this brings us to a really fascinating roadblock. To find a stock's intrinsic value, Graham used a very famous formula based on earnings per share and book value. But when we try to run AutoZone through this formula, well, what happens when a valuation formula mathematically breaks? Like, why does it literally snap in half here?
Okay, here's the answer. Graham's formula requires you to multiply the EPS by the book value per share, and then take the square root of that. but AutoZone's total stockholders' equity is negative $2.9 billion. And, as we all know, you cannot take the square root of a negative number. It just doesn't work. Now, this isn't because the company is failing, far from it. It's because AutoZone has aggressively used its cash to buy back almost $40 billion of its own stock since 1998, which artificially drives its accounting book value into a deep, deep deficit. Graham's 1930s framework simply cannot comprehend a modern share cannibal like AutoZone.
Section 5. DCF and Alternative Valuations.
Since the old-school formulas are clearly struggling with these modern capital structures, let's run some standard quantitative models, specifically a discounted cash flow analysis. To calculate the present value of AutoZone's future cash, we have to set some assumptions. We start with that $1.63 billion free cash flow base we talked about. We will discount those future cash flows back to today using a weighted average cost of capital, or WACC, of 5.43%, which really reflects their highly efficient debt structure. And finally, we'll assume a perpetual terminal growth rate of 2%, which essentially just matches long-term inflation.
When we actually run those numbers, we arrive at a base case fair value right around $3,150 per share. But I want to draw your attention to how this brilliantly illustrates how fragile a DCF can be. If interest rates rise and push that discount rate up to 6.5%, the fair value plummets. On the flip side, if they successfully compound cash faster than 2% forever, the value skyrockets. But looking at our base case, sitting at roughly $3,150, the stock is currently trading right at its fair intrinsic value. It is, for all intents and purposes, perfectly priced.
And we can cross-reference this with alternative valuation multiples. We're looking at an enterprise value to EBITDA ratio of 14.5 and a forward PE of just under 18. For a company generating nearly 27% returns on invested capital, these multiples are extremely reasonable. The market is definitely not demanding a massive premium here, but it's not offering a deep discount either.
Finally, Section 6. Synthesis and Final Verdict.
So, we have looked at the business, we've evaluated it through the eyes of the investing legends, and we've run the cold hard math. Let's synthesize all of this. Buffett would recognize the incredible moat in ROIC for sure, but he would likely demand a 15 to 20% margin of safety, meaning his target buy price is probably closer to the $2,600 range. Lynch says it's a solid stalwart, but with 93% institutional ownership, it's a strict hold for him. Graham rejects it entirely because the modern balance sheet math just totally breaks his defensive rules. And our quantitative DCF model, it tells us the stock is a hold, currently trading right at its fair value of roughly $3,150. Which brings us to our final definitive verdict based on the data. AutoZone is a phenomenal, highly resilient business that is currently priced for absolute perfection. They are returning incredible amounts of capital to shareholders through buybacks, and that has driven EPS through the roof. However, at $3,013 a share, you are paying exactly what it's worth. So our takeaway? Keep this one on your premium watch list. Look for a broader market pullback to achieve a solid margin of safety before initiating a position.
I want to leave you all with this final thought today. As we saw with Benjamin Graham's math earlier, in modern finance, a broken formula doesn't mean a broken company, it just means we need a better lens. AutoZone's negative book value would absolutely terrify an investor from 1950, but today, it's the signature of a wildly successful capital allocation strategy. Always question the math, understand the actual business beneath the numbers, and keep learning. Thank you so much for joining me for this explainer, and I will see you in the next one.